And so in touching on that educational component, now you talk directly with investment advisors about adoption. And so maybe share with us a little bit of the shift, because I think one of the things that when we had Joel Revel on, he mentioned that investment advisors still hadn't really gotten it. Maybe part of it is because they didn't have the right alternatives and it's a little risky. But what's those conversations like today? What are the concerns that are being raised to you? Like, how is that? What's the shape of that discussion?
Yeah, I'd start with many financial advisors still don't understand why blockchain and why public blockchains that are backed by crypto assets need to exist. They either envision Bitcoin as something that they'll use to buy a mocha frappuccino, or they think someone created an Excel spreadsheet and just changes lines on it. So you still need to have a fundamental conversation about not what mining is, but what blockchain is. The thing that's changed over the last 3 years, a few things have changed, probably two big things. One, the percentage of people who think it's going away has fallen dramatically. And I don't say that anecdotally. We did a survey of 1,000 advisors. The percentage of people, we've done it every year for 3 years, the percentage of those advisors who think the price is going below $1,000 has fallen from something, and I don't remember the exact statistics, something like 40% 2 years ago to something like 8% today. It's been a dramatic shift. So I think that concept that this is just going away is going away. And it's hard to overstate how important that is. Because if you think that a digital store of value and a decentralized finance market is going to exist, if you accept that precondition, it's hard to argue that it won't become extremely important. Once you accept that it will exist into the world, it's hard to imagine that it will be an obscure asset held by a small variety of people that accounts for 4% of the market cap of gold or whatever it is. Your timeline to getting it to be truly substantial may be longer than mine, but once you accept that it exists, the eventual point you get to is pretty significant. And that's a shift that's happened. The other shift that happened is just the easy no's have gone away. You can often present an idea to somebody and they're like, oh, well, who's the custodian? I've never heard of them. Are they regulated? No. Do they have insurance? No. Okay, next. And people used to have those easy outs. The outs are much harder now. It's qualified custodian, there's liquid trading, Jane Street's making markets in it, Mass Mutual is investing, BlackRock is owning it in its global Al fund, or at least has the ability to. So the easy outs have gone away. People have accepted that it itself is not going away. And that creates much more interesting conversations where you can't ignore it. You have to wrestle with it.
And I also think, I feel like in the last month or so, you're seeing more stories about quiet accumulation by large institutions, that the worst kept secrets is that they're trying to quietly accumulate it, which I think is intriguing. And for those who are paying attention to it, it's worth paying attention to.